Welcome to the Twomey Stock Market Report. Today is Wednesday, September 21st, 2022. I'm James Twomey, and let's dive into what's going on in the market. Right now, if you're trying to be an active trader, it's a very difficult time, as we've all seen. If you're a long-term investor, it's also been very difficult because you've seen your 401k, for example, or your life savings really tank depending how aggressive you were in your portfolio. I guess what I'm going to tell or address people right now, if you're in these long-term 401k, you got to still keep adding to your 401k, because if you don't, you're not going to get advantage of these low prices. Can the market go further south? Yes. Can the market rebound and go up? Maybe. All in all, and we're going to delve into a little bit more detailed, I would say, later, but overall, you want to keep adding to your 401k. You have to, especially if your time horizon is 10, 15 years or greater. If it's shorter and you didn't take your money out, or you redistribute your savings, you're kind of in a conundrum, right? And you're almost forced that you're going to buy at these low levels in the hopes that the market does rebound. I don't know if it will in a couple of years, but you probably don't have a lot of choices. Other than that, if you've got cash, I-series bonds, they're 10-year I-series bonds. They're offering 9.6% now for next 6 months. Prior to that, it was 11 point something percent. It resets every 6 months. It can only go up to 10K a year. It is non-retirement money. If you've got that cash, you want to buy those, just park them there for you or your kids and just let them sit there. There is some penalties if you take out earlier than 3 to 5 years or 7 years. Go to the Series I Bonds government website. They'll explain it all. You can add in as much as $25 at a time, $25. So you can just put a little bit at to work, or you can buy a lump sum. There's all kinds of ways to do it, and it's a direct purchase. So very easy. That's money you want to put there and let it go. I mean, let's say interest rates stay high in the next several years. You're somewhere between 10 and 3, 4, 5, 7%. That's pretty good money. You can't get that anywhere else right now. And then after that, the next bunch of years, if it's abates, gets down to low percentage numbers, you still have gotten that great gain over the short period of time, and you're not going to take it out anyways for a period of time. So it's a great way to park money. Short-term treasuries, 3.2 years are offering, 2-year treasury offering 3.65, not such a bad place. Municipal bonds are good. These are all another way to get some tax exempt, especially certain state ones, depending where you live. I heard one was offering 5%. I don't know which state it was, Illinois maybe. But, there's another way to park your money. You're tying up your cash for a little bit of time. There are some penalties, early withdrawal, et cetera, et cetera. But I'm not in the prediction business, but I think this malaise and high interest rates are here for a while, at least for a couple of years. But that's some insight there. Let's get into some of our, active trading. First of all, foremost, you got to go to TwomeyStocks.com. The website's now live. We are still making improvements for to clean up some of the way we post things. But with that said, the number 2, MEstocks.com. That's the number 2, MEstocks.com. You got to make his go-to page. On the front page, you'll see where, it's got our newsletter. It's got our trade table. Also, right over here on the right side, receive trade alerts. You've got to sign up for your trade alerts. So we sent out a couple yesterday, some today. They get posted on the site. You got to be a member to get that. Very important. We're in all access stage right now, but eventually that's going to go away, and we're putting more focus into the newsletter and the videos there and the training. And we're getting less time to post on the YouTube. I'm trying to get some folks to help me out with that. But with that said, you want to get to the number 2, MEstocks.com, and check that out every day. We've got something, especially the alerts are coming out fast and furious. The alerts get emailed right to your desk, to your email. So wherever you are, it comes in, And if you're like me, you're on the golf course, you don't have a lot of time, you want to get this information. All right, Twomey investment is very important. We're going to go into some, trading philosophies, but overall, you want to look at the trend. Yeah, can you look at the trend? Is it down? Sure. Or up? Yeah, it doesn't take a rocket scientist, but it's very important to really take a step back and take a look at that and make sure where you are in the big picture. The macroeconomics, that's very important. How the economies, what's changing in the economic output, inflation, interest, exchange rates between countries, balance of payments. It's the bigger picture of economics, not the smaller picture. Important and very important to understand that. I put company stock analysis in this category. I call it fundamentals. We're looking at the health of a company. We look at all the technical ratios. There's like last newsletter, I posted 6 or 7 that are important to review. Some you can pick up right off of schwab.com or Yahoo or other websites. I use Street Smart Edge from Schwab. It has a lot of information in there. Saves me a lot of time for number crunching, but it gives you the health of companies, and that's kind of the fundamental analysis. Very important you understand and how to get into it. It does take time to digest. Then we look at the environmental influences and sector analysis, fiscal policy, government spending, taxation, global concerns. A little bit of a gray area, but it's a smaller, tighter picture than the big economical picture. Then we look at advanced decline and RSI. Based on that, we develop our trading, what I call bias. We don't want to be married to that bias, and that's exactly why I use the word bias, because oftentimes you look at a chart, you look at the fundamentals, your bias is developed, and it goes against, all of a sudden the market goes against that bias, and you say, wait a minute, that can't be right. But it is. So you want to be understanding that you've developed this philosophy, you make your decision. You don't want that to become a long-term bias, and then when the market turns, then you make a mistake and you don't get in or out. That's why we have our technicals, we have our guide rails, and that's where the Twomey stock market report comes in and our alerts, because we're looking at this all day long. We're really making those analysis. The trades we're picking are based on what the sector and the environment is saying. Right now, to go long, it's very dangerous, but there are some trades, like we had our energy trades and materials and some of those. We saw some reversed very quickly last week that we thought we should go in. We used our green plays to take the euphoria of the market and the bill that was passed. We took advantage of those. Again, the market on long trades is very dangerous and it's trading very fast. We'll pick some. We can make some spectacular profits, but they aren't lasting. The trend has been down and it's continued. All right, so big trend picture. Right? It doesn't take a rocket scientist. The red line's been down all year. We did have the summer rally. We talked about that quite a bit. We got our buy signal. We jumped in, and then we've got our sell signal out. Then now it's starting to come down. It's really hitting. It's really hitting the supply line, the lows of June, and we get into this much more detailed chart. I'm going to go real time in these charts. Let's see. Let's go to the SPY. SPY. This is the daily chart of the S&P. We use the SPY as our proxy for the S&P, right? So this is 500 companies, S&P. What am I talking about here on long-term trend? That's a 10-minute chart, pardon me. Let's go to the daily. Okay, there we go. See the overall trend. We're back into this yearly downtrend line, the Twomey trend track line. We have a shorter Twomey trend track line forming, and every time it's gotten down to that, we've had a rebound. It's getting down there again. But the difference here, it's getting into what I call the supply line. When we had the lows in June and the market started to rebound, it was a sideways move to, mid to end of July. So 4 weeks of buyers and sellers kind of not deciding where to go. So let's put our sentiment hat on. I'm getting down here. I'm short. I'm looking at a number of things, and we're going to go over those next. And I'm saying to myself, wait a minute, some of these indicators saying the market might be getting a little tired on the short side, and we might have a bounce. We've got the Fed coming out, so we've got to, kind of wade through the news and the event of that this week. But with that said, think about it this way. These folks who bought here, fortunate enough to buy it this bounce, they enjoyed a nice ride. And now if they didn't get out, now we got out, we sold our longs, we went short, we've enjoyed this downtrend. But with that said, if you hadn't, and we start getting down here, you're going to say to yourself, wait a minute, that's where I got in. I'm going to sell. I'm going to be break even. I just can't take it anymore. So you're going to have those people sell. The people who missed the trend and didn't get in are going to say, hey, we're back down here. I've got my second chance. I'm going to buy. The dip kind of crowd starts surfacing again. What I found last week listening to the pundits were a lot of, not that the market was showing signs of exhaustion as far as everybody's out and that's when a bounce occurs, more of like, I don't know where to put my money other than some of these things we talked earlier in the segment. They look at, you can go into McDonald's, you can go to, Marathon Oil or some of these, or Exxon, some of these things, healthcare, United Health, but they weren't really excited about it. Actually, I bought some McDonald's because it was near the 200, but I'm not excited about it. I'm not sure. It's not a buy signal. And anyways, with that said, that's the way the sentiment is. Nobody's really excited about the market. That kind of tells you, well, maybe selling is abating. I don't know. So we took a deeper dive. I'm going to expand this. So that's what's cooking, right? I also look at the sector table. I look at the advanced decline, the relative strength index. That sets my tone and picture. Matter of fact, let's do that right now. Let's go to that sector table. The last I sort it usually on 1 month, right? And what's been hot? Well, everything's red. Everything's red. Energy had been up there. That's still -1, not so bad. But the shorter term, it's been -4, -3. I look at the utilities, another safe play. That's been negative the past month. I look at materials, which usually does well. That's not doing well. It's way down here now. We actually got, if you were getting our alerts, we were in and then we were out. In some cases, we're back in. So, it's happening very rapid. It's not a very good market to go long. 6 month, the sector is saying the only thing that's been positive is energy, and it was, year to date in the 50s, but now it's 30. And utilities. Utilities usually a safe haven. I think utilities may struggle because people are going into short-term treasuries or munis right now. Anyways, the sector telling me not a real good environment to go long. The relative strength index that's been a great trend for the summer. Look at the SPY the past 4 or 5 weeks. The SPY 61 over. We get into the high 60s, that's overbought. When you get into 70, it's a red light that the market's exhausting the buying, right? Well, the next week it went down to 44. That's a huge swing. Then it went to 35, and then that's starting to say the market's oversold. That we're going to have a bounce. Sure enough, early September, bang, back up into the 50 in 1 week, 35 to high 50s, well, mid 50s, and then now we're back down to 30. It has been a good indicator for this kind of trading range that we're in. I'm going to go over some examples that don't prove that out. It is not the end all and be all. If you go to my newsletters, they'll have all the discussion on that. But for this, it's safe to say it's been a kind of a great short-term indicator for us. If you want to be an active trader, right? And then if you look down here, TBT, which have been long for a while, or TBF, depending on what you want to, look at. TBF is the 1-to-1. TBT would be the 200%, right? Look at the RSI, 58, 53, 61, 62, 64. I pushed this up here to make it stand out. Push this one up to make it stand out. The TLT is the Okay, bonds, yields. As interest rates rise and the bonds have to pay higher returns, the yield goes up. The opposite happens when interest rates come down. Bonds don't have to provide as much yield or interest, return on your money, so that comes down. TLT measures it as it comes down. That's in the low 30s. It stayed in the low 30s for weeks, kind of hit the mid 40s, but it's been very stable, and the TLT's been going down. TBT's been very high on the RSI, and it hasn't moved anywhere, really. Price-wise, it's been going up. So, RSI is not the end-all and be-all. If you're in the macro trend and you're in the right side of the trade, the RSI can stay elevated or deflated for some period of time. Here's the TBT. This is 2 times the negative, the inverse of the yield. In other words, if yields go up, bonds pay higher interest rates, this is going to go up. Okay, look at this Twomey trend track line, very narrow, but every time it comes down and hits the bottom, it's been repelled. And here it's not even getting halfway down and it's being repelled, and that's telling us there's pressure to raise yields. So we've been long here, and we were certainly long all year long. Look at the rise here, and then we got out for a while, and now we're back in. So RSI is, the lowest, here, on the bottom it was 63 and it rebounded. Here it was 62 and it rebounded. Down here it was a high of 54, kind of abated, but it went to a low of 51. Up here it got as high as 64 and abated down to 53. So we're not seeing that big swoon we see in the SPY where it goes, 30 to 60 in a matter of a week. And that's been a little bit more of an indicator of the market, right? Of getting in and getting out. So what am I saying here? I'm going to go back to my real-time charts. We're going to go to SPY, and we're going to take a smaller picture. If you're an active trader, what do I look at? Well, I first start every day. I look at the stochastics. Stochastics is I define it in my newsletter, so you can get that information. You can Google it, and they'll give you the settings. But just for argument's sake, it's a quicker trending indicator of if you want to trade like on a day, day trade. I use it to say where is the immediate picture of the market. Well, the market. I'll give you an example. Last week, the market was going up a little bit, and earlier this week, right? I go down here and I look at the stochastics. We had a reading of 11. We had a reading of, now it's 21, and now it's back down to 16. That's the fast. The slow is, a little bit less than that. But over here was down at 5. So I was like, wow, that's telling me that the market is ready for a rebound. Anytime you get below 10, I'm saying that there's pressure on the market to rebound. That's sure enough, it did rebound a little bit. The green crossed the red, and then, now the green and red are kind of, interchanging on an hourly basis, right? I don't trade off of this. If you look here, every time the green crosses the red, you'd get in, and every time the green crosses below, you get out. It's just too fast, right? But it's a good indicator, especially at the bottom. But see here how it stayed for, let's see, that was 826 to 96. Was way here at the bottom waiting for a bump, and sure enough, we got the bump, right? And then I look at the MACD. All right, the MACD. If you look at the MACD, that's the green and the red line here. I'm sorry, my volume lines are really kind of covering it. But look at this. It's a longer trade, right? You see here, cross positive, the green's positive. It's still not in above 0. 0 is a real more positive indicator. But if you see here, it crossed above, the market went sideways, went above 0, and all of a sudden the market raced off, and green stayed above the red. And then it crossed below at the red here. Now would be a good time to get out. And then it's down. So that could be a much easier way to trend the market if you're an active trader. That's a really good sign. Right now, I look at the stochastics. Anything below 10, I'm like, the market's probably going to rebound. Short term. I look at the MACD. The MACD is not telling me anything along those lines. It's the opposite. The red's above the green. It's still below zero. It is still a negative reading, -5. Yeah, I'm not convinced. I look up here at my bigger table, the day-to-day, we're getting closer to this Twomey trend track line. It's been repelled the last couple of times. We just re-entered the bigger downtrend for the year. It could potentially get down to this below of the June lows. We're heading that way potentially. So we've got this supply line. We've got this 4 weeks or so of where buyers and sellers weren't sure where to go. Yeah, we might get a bounce. We've got the Fed coming up. I'm just saying, let's keep our shorts. We don't have a buy signal on the longs. All right, we're the long, we're well below the 9 EMA, we're well below the 15, we're well below the 50, we're well below the Twomey upper trend track line, we're well below the 200. Yeah, there's maybe some potential for a bounce here after the Fed. The Fed, maybe, people may say, well, the Fed comes out at 0.75. Let's say if he comes out and he says, wait a minute, we're going to be data dependent. We think we've got a handle on it. We're not sure what we may slow down our rates of increase. The market's going to race off. If he comes out and says we're pedal to the metal, 0.75, we're going to continue what we've said. We're going to continue tightening by running off a balance sheet. We're going well into next quarter. Inflation is not really healthy. We see this sticking around for a long time. Fantastic. If you read my newsletter, there's other shoes to drop. We talk about how the manufacturing and the service sector tracking data, it's a little rearview mirror, but that has to go below 50. Once that does, that's one shoe of the remaining 4 that I look at, and the last one would be employment. Right now, Kramer's out on the West Coast at some kind of thing, and he's all over the place, right? So he's got a great, when I say all over the place, talking to executives, he's in these meetings, he's very well plugged in, he's got a huge staff. He's saying that all the executives this week have been saying that hiring's been a lot easier, they're not having as much trouble. That's telling me employment is loosening with this. We may start seeing these layoffs exasperate, and if they do, that's going to be really, pressure on the market, and therefore we really need employment to come down. As long as people are working, even though prices are high, they're going to be able to afford it. If they lose their jobs, it's going to be terrible. If we have unemployment reach 5, 6, 7%, it's going to be horrific because prices are through the roof. Right now, I know here in the Northeast, people are getting their new rates on electricity because they resize those twice a year and they've doubled. I mean, I don't care who you are. It's going to be very hard to pay your electric bill if it doubles. Pure and simple. All right, so back to our story. Whoa, what's going on here, folks? There you go. A little bit of electricity blackout as soon as I'm talking about rates. All right, so there you go. You've got the sentiment down, RSI. Today, this is a real-time chart. What is it reading? It's 38. It was 35. This is the SPY, the long. Are we near oversold territory a little bit? We're down, kind of coming down to our supply line. Our trend track line. Our stochastics improved a little bit, but not much. MACD, a little bit, but still negative. The supply line, I'm not ready to go long. I would wait until my buy signal. All right. So yeah, that's how I make my decisions. I look at all those factors. You throw that into the hopper, and that gives you a picture of where to trade. Okay. So I want to take a look at some of our short positions, and then I think we'll call it a day here on this segment, and then we're going to have in the next segment we're going to talk a little bit about midterm elections and how that has impact on the market and how to set up your trade philosophies. And it's very important. So that should come out in the next day or two. And we're gonna take a look at some previous ones, we looked at fundamentals, we looked at cash flow, we looked at P&E ratios. I gave you a list of 6 or 7 fundamentally items that you need to look at to understand the health of the stock or the company that you want to invest in. Some of them are very heavily in data crunching. Some you can get right off. I use Street Smart Edge Schwab. You can get a lot of that information off of Schwab, Street Smart Edge, and others. You just have to crank the numbers. I know it's data intensive. It takes years to kind of really develop this. It's tedious. That's why we give you the stock trades. That's why we provide the alerts. You want to sign up for those at the number 2 mestocks.com. We do the work for you. You reap the rewards. All right, we've been short. We had our buy signal. We've stayed short. We want to, if they pull back a little bit, I'm in the camp or bias of adding to these shorts. And we're going to have to just see how that goes. And then you'll get the alerts for that. And let's see, that's the SPY. Let's look at the DOG, which is the diamonds, or the Dow Industrials. Yep, we're still in the uptrend. We're about halfway between the Twomey trend track line. We haven't hit our 9. We haven't hit our 15. We're above our 50. We're above our 200. Stochastics, way up here in the 80s, very healthy, but they are turning down a little bit. MACD, we're up in the higher percentage numbers. The green's well above the red. It's been there extended for a while. All looking pretty solid. We expect a little bit of pullback because why? The RSI up here was got up into the mid 60s, 63, 60, 64, last couple of days. So it's extended and it kind of getting up to the upper trend line. It's pulled back a little bit. We're going to have to see what the Fed comes out and says. And, we probably might get a little bit of a relief rally here, but we'll see. We'll see. So you want to keep a track on that. We had some energy plays that we got out. UNG, natural gas, the gas woes in Europe is really where it's affected us, but it has caused our gas to go higher. But, it's volatile trading. We got our sell signal. We got out, sure, we had a couple of bumps here. We look like, did we make the right decision? Yes. Look at it's way down here. It's pulled back quite a bit, and it's in a very. It changes very rapidly. You could wake up and it could be down, 4 or 5%, and vice versa, right? So it's a risky trade. You want to kind of stay out of it. Right now, stochastics negative. The green's trying to cross above the red. MACD is still all in negative territory. This little pattern, I call it, stock pattern, where you had a high and then you come down, you get a little bit of a bump. I don't know if you can see it, there, but it gets up and more selling. Gets up, more selling. Came here and we had a nice run up and then more selling. Usually right around here, you tend to want to get back in your trade, right? Well, we stayed in it, so we were able to handle some of these ups and downs, but then we got out of our trade right here, right? And, it certainly went down, and we looked around here, and we didn't get in, and thank God we didn't, because boom, straight down. So this kind of pattern I see, especially when we start seeing this lower lows and lower highs, I don't like it, and I tend to stay away from it. Yeah, once we get the sell signal, so it's a very telltale pattern. Keep your eye out for that. We got into the Piedmont Lithium. It's the lithium play. This is a very risky company. It's kind of just getting started. Doesn't really have sales. They're pushing money out they're expanding their development and mines. They're going to open up some stuff in North Carolina. Was Tennessee the other one? But either way, I put it in the newsletter. And, we had a nice ride up. We got out, and then we got back in, and it's been going sideways. So we're going to hold this for a little bit. We're going to see what's happening. The euphoria of that news is kind of broken, but it's hanging in there. So we're staying with that. But our other energy plays were pretty much out. XLE was the other one. Same story, same pattern as UNG. And if it returns, we'll take a look at it. The other one was utilities X. These are all ETFs now. You got to be in a stock pickers market. You got to pick the right ones. They're hard to find. We use our sector table. We use our other analysis. But for the most part, it's been tough. And again, here's this crazy pattern again. Down, down, down. Lower lows, lower highs. We got our sell signal. We stayed out. We're out. We're waiting for something to develop on the utility sector. It hasn't as of yet. We'll keep an eye on that. Certainly are some utility smaller companies that still are showing some positive, but we're not getting into it at this point in time. Okay. That gives us a little bit of a synopsis of our trading. There's more on our website, TwomeyStocks.com. Go there. You can see our trade tracker, past and present trades, so at least the last several weeks. And then we also have our newsletter. It's all access for a while. You have to sign up for you should sign up for our alerts, because that's the activity that we're sending out on a daily basis. Get some of these trades. Everything's moving fast. In our next segment, we're going to get a video. We're going to talk a little bit more detail about some of the environmental factors and how that affects our trading philosophy. Let's see if we have some more information to go back. We talked about our relative strength index. We talked about our sector analysis. We took a deeper dive. Advanced decline. Advanced decline, you can get that. Read on the newsletter. It's safe to say right now we're in the advances have abated, and this pattern that lower lows, lower highs is developing. We're in that downtrend again. We're well below. RSI is at 39. MACDs are in negative territory. Could we see a little bit of bounce? It'd be interesting if we break this bottom. It goes back to, are we going to break? Are we going to break? We'll go back to our SPY, the supply line, or are we going to bounce off it? And that's where we are now. We're going more to develop. Typically the market tests its lows, and then if it holds and starts moving, you get a nice rally. And that's I'm sort of leaning in that camp. But our next segment, when we talk about how midterms affect, that's going to be very important. So stay tuned for that. In the meantime, enjoy your trading. We'd love to get you involved in more detail here. Do that on the Twomey Stock Market Report. That's number 2, mestocks.com. You can email us at info@twomeystocks.com for input. It's been great. We've been getting a lot of information, a lot of questions about a little bit more on how do I understand the trade more as an active trader. How do I understand setting up my trade desk? We're going to get some of those training videos out there on the website. It's a lot of information, and the data that comes out, the fundamentals, the analysis, it takes years to really fully understand that, because you have to see a business cycle, an economic cycle, and you got to see a company cycle before you understand it fully. We're also going to, I'm going to give you some next segment, talk about some PE ratios again, and I want to show you the pitfalls that I think we're up against. So stay tuned for that. You can follow us on Twitter at Twomey Stocks, Instagram at Twomey Stocks. I'm James Twomey. Enjoy your day, and today's Wednesday, September 21st. Have a great day.